Has your realtor recently mentioned the term appraisal gap and you're wondering what he or she's talking about? You need to watch this video. We're going to break it down and tell you why it's a relevant term in the spring 2022 housing market. Lauren?
So if you're wondering what an appraisal gap is, the appraisal gap is the difference between the price you're willing to pay for the home and the appraised value. So in this market right now, we're finding a lot of buyers are writing clauses into the contract that say they're going to cover that gap.
Okay, why are they doing that?
So they can win an offer, right? So if they position themselves that they are going to cover the gap, then the low appraisal that may come in is irrelevant, right? So the appraisal is not going to be the reason that the deal falls through.
Right. So they're doing it, in other words, because they're trying to outbid other people who want to buy the same house.
Correct.
Right? So
Correct.
they're paying over asking by, in some cases, a substantial amount.
Substantial amount. And then creating bidding wars, right? So when a buyer goes in and they're offering to cover appraisal gap, they're offering to waive contingencies for appraisal, for inspection.
Yep.
There's really no reason that the deal is going to fall through, right? Then they're coming in with a short closing offer on the table. So it's helping clients to win deals, and it's helping them to, for the deal not to fall through.
Well, that's good news if you're the seller, right?
It's great news if you're the seller.
Right? And you're expecting to sell your house for $500,000 and somebody offers you $600,000. Okay, so what happens when that appraisal comes in and it doesn't hit at $600,000? Maybe it hits at $500,000 or $525,000 or something significantly less than the actual purchase price. What's the next step in that process?
Yeah, so now the buyer has to come up with those additional funds to be able to cover that gap.
Right.
So the problem with that is that's then tapping into the money that they had for other things, right? Down payment, for example, fees, closing costs, reserve requirements, maybe money that they were going to use to furnish the house,
Sure,
moving expenses, any remodeling they wanted to do or improvements in the home. So it's a problem because clients are now having to come up with additional funds that they may have not expected or not have planned for and not have had to worry about in the past. But now it's very real that clients need additional money.
So this is catastrophic for first-time home buyers.
No equity to use, correct.
Yeah, who have saved, 5-10% down, maybe even a little bit more. I mean, what exactly are they going to do in this situation?
Yeah, I mean, when you don't have equity from a home sale, I mean, that really limits you as to what you can do, right?
So whether or not you're a first-time home buyer or you already own a house that you intend to sell at some point, but you need to buy your next home first, we're going to go over some solutions on how to deal with an appraisal gap.
Yeah, I think the first one that comes to mind is gift funds, if somebody has that available. So that would be money received from an immediate family member that you would be able to use for the transaction. So toward down payment, toward appraisal gap. So if that's an option for you, that's certainly a great one to entertain. The other one that comes to mind is higher loan to value. So borrowing more, financing more on the mortgage, putting less down. So if you're thinking, I want to put 20% down, but now you need money for appraisal gap. Put down 5% instead and use that 15% to fund the appraisal gap. It's another great option.
Yeah, that is really smart. And for those of you that have assets, there's a few ideas that we have there as well. You could use secured funds. That would be money from a 401k. It might be, a line of credit that you have secured to your brokerage account or your IRA that your financial advisor can help you with. You'd be surprised what they can do.
Yep.
And you don't actually, my understanding is the way these are structured, you don't actually, that money doesn't actually leave your portfolio. It's just the collateral in case you don't pay the bill at some point, right? Okay. So if you have that as a resource, secured funds would be a great option for you. Another great option that comes to mind is an 80-20 loan, which is basically 100% financing. It's a first mortgage at 80%. It's a second mortgage at 20%. There's no down payment that's required with this. There's an important disclaimer I need to give you with this, right? So when you buy a house at, let's say the purchase price is $600,000, for example, and then the appraisal is done and it comes in at $500,000, and you make the decision you're going to eat that $100,000 appraisal deficiency, right? Your down payment is going to be based on that $500,000 appraised value. It's always based on the lesser of the purchase price or the appraised value, whichever one's lower, right? So if you were going to do 10% down, for example, it would be on that $500,000, which would be a loan amount of $450,000. So you'd have the $100,000 in the appraisal gap, then you'd have another $50,000 that you'd have due. So in this example, you would do a first mortgage at 80% of the 500,000, which is 400,000, right? Then you would have a second mortgage at that remaining 20%, which in this case is $100,000. You add up the first, you add up the second, you get 500 grand. That's 100% financing. You take the money that you were normally going to put for the down payment, and instead you would cover that $100,000 appraisal gap. So
yeah, the 80/20 is a great option, and there's no PMI on the 80/20.
No.
And that second, that HELOC can remain, right? So that can be a lifeline, that could be an emergency line that customers can use at any time. That would remain for as long as they wanted to keep that.
Yeah, so the second mortgage is on a line of credit,
Yep.
which typically is prime plus something. So it's a variable rate, but it's an interest-only payment requirement for the first X number of years of the term of the loan, which is usually a 30-year loan. So more or less what that means is the actual payment that you need to make is going to be less than if it was a fully amortized deal where you've got to make principal and interest payments. So it's actually going to give you
PMI potentially,
and you avoid the PMI,
Yep.
right? So you could pay that down over time and then borrow from it, pay it down, borrow from it, and it functions like a super inexpensive credit card.
Yep, definitely. And I feel like in a lot of cases, clients are actually using that, keeping that active and paying off high interest credit cards or paying off other things that have higher interest rates.
I mean, downstream, I mean, I would. Maybe they want to spruce up the house a little bit,
Sure.
or I mean, they don't want
always
to
have that option.
Yeah, it's like it's a safety net.
Yeah,
right.
Definitely. Yeah, so if you guys have specific questions on this topic, appraisal gap, or any other questions at all, our information will be on the next slide. We're always here, happy to help 7 days a week. So if you need anything, please let us know. Thanks for tuning in to A Lending Hand with Lauren and Eric. We'll see you next time.